Now, this is a very important development because what it does is it signals to everyone outside the Americas that American hegemony is not going to be such a problem as it has been in the past. Now, obviously, the Americans will still have their presence here, there, and everywhere, but that's not where their future interest really lies. So that does mean that you can move your trade settlements away and your trade. Well, I think the most important signal is what's happening to the gold being priced in dollars, and for that matter in other currencies. I mean, it's surprised, I think, most people the way it appears to have risen. But of course, most people look at it in the belief that it's gold rising rather than the dollar falling. But when people do understand it's the dollar falling, then you can understand that really what we're seeing is a very, very important event. And it's falling at an accelerating rate. And I'm looking at gold today, it's at 5,300. I mean, this is what, where are we? Wednesday the 28th. So, that is an enormous rise, if you like, if you think just in terms of its gold rising. But it's also an enormous fall if you think in terms of the dollar falling. Now, taking up that theme, the geopolitical situation, I think, is probably the most important factor we ought to look at. Because what is changing the price relationship between dollars and gold, basically, is the informed funds. I mean, central banks, governments, government wealth funds, large foreign owners of dollars are basically selling dollars and buying gold. Gold is real money. They understand this, and they're getting into it. Now, silver also, for most of Asia, is real money, so they're going into that. So what is actually happening? Well, China has already anticipated this. It anticipated this a long time ago because the Marxist universities always taught that capitalism would create its own destruction, and obviously the fiat currencies of the capitalists would go down with it. So the Chinese have prepared for this, and as I've said many times before, they really started accumulating gold in earnest and not declaring it in the sense of putting it on the PBOC's reserves way back from 1983.
The most influential buyers in today's gold market are not speculators or retail investors, but institutions. Central banks, sovereign wealth funds, and large reserve holders have been steadily reducing dollar exposure while increasing allocations to gold. This shift reflects a strategic reassessment of reserve safety in a world of rising geopolitical fragmentation. In much of Asia, silver also retains monetary significance, reinforcing demand beyond industrial use. These buyers operate on long-time horizons and tend to move early, well before broader markets recognize structural change.
What I haven't talked about quite so much is what they've been doing with silver, but I'll come on to that in a moment. The Chinese have had the approach, if you like, that they don't want to be blamed for destabilizing the fiat currency system. Apart from anything else, their own currency is a fiat currency as well. So they need to be in a position to secure that value before anything happens. And they've made some pretty good moves in that direction, really, since what President Trump called Independence Day, April the 2nd last year, when he started pushing through big tariff increases on every nation around the world. What China did, well, President Xi did two things at that stage. What he did was he accelerated the discussions between South Korea, China, and Japan about a free trade area between those three very, very important nations. And the week after that Independence Day, he did a whistle-stop tour around Southeast Asia, basically the nations where you got very influential Chinese diasporas. And we don't know what he told them, but there was obviously some reason for him to do this. And what has transpired is that we're looking at the construction of a free trade area, which is not just Shanghai Cooperation Organization and BRICS, but pretty much the whole of the Pacific, if you like, excluding obviously America. The other thing which wasn't mentioned at all in any of this, and I don't think anyone has really sort of speculated on this other than me, and that is he would have talked about the payment system. And shortly after that, the Chinese government, through the Shanghai Gold Exchange, announced that they were opening, for the first time, SGE vaults outside China. This is really quite a development. And the two vaults which have been announced so far are Hong Kong and also Saudi Arabia.
China's accumulation of precious metals is not a recent reaction, but the result of decades of planning. Gold purchases began in earnest long before public disclosures, often flowing through domestic channels rather than official reserve statements. Less visible, but equally important, has been China's quiet positioning in silver. The objective has never been to destabilize the global system outright, but to ensure monetary resilience before any disruption occurs. This approach reflects a strategic preference for preparation over confrontation in periods of systemic transition.
Now, this really covers the two wealthiest regions on the Asian continent, or Middle East oil and all the rest of it, and also, the Far East, the very productive and wealthy Far East. So that was a very important development. And only this week, there's been a further announcement insofar as not only has the Shanghai Gold Exchange set up vaulting facilities in Hong Kong, but they've also come to an agreement with the Hong Kong government for the Hong Kong government, in effect, or Hong Kong monetary authorities, whatever, to act as the offshore center for gold transactions for the Shanghai Gold Exchange. And what they're talking about is a joint facility which is planned to have a maximum of around about 2,000 tons over the next 3 years or so. So this is important. Now, the reason this is important in terms of securing the value of the yuan while other fiat currencies lose value is that gold can be shipped in and shipped out of these vaults, basically in exchange for yuan currency. No other currency works for this. At some stage, we can expect China to fix the rate to secure the value of the yuan. In other words, as the dollar goes down, there will come a point where China feels comfortable in fixing the rate for trade settlement, for international trade settlement purposes, for the yuan, a yuan gold exchange rate, to secure the value of the yuan in that context. We're getting very close to that. Now, the other thing that's interesting in recent weeks has been the emergence of the Monroe Doctrine. Now, the Monroe Doctrine, basically, which some people are calling the Donroe Doctrine now, basically is one where America emphasizes her control over the Americas totally, and to that extent recognizes that the rest of the world is a multipolar world in geopolitical terms.
Recent trade tensions accelerated China's push toward alternative settlement systems. Regional trade discussions in East Asia expanded rapidly alongside outreach across Southeast Asia and the Middle East. Parallel to this, China advanced gold market infrastructure by establishing offshore vaulting and settlement hubs tied to the Shanghai Gold Exchange. These facilities enable gold to move directly in support of trade settlement, reducing reliance on intermediary currencies. Control over physical settlement mechanisms is critical. It allows trade to function even as trust in traditional financial plumbing weakens.
Now, this is a very important development because what it does is it signals to everyone outside the Americas, that American hegemony is not going to be such a problem as it has been in the past. Now, obviously, the Americans will still have their presence here, there, and everywhere, but that's not where their future interest really lies. So that does mean that you can move your trade settlements away, and your trade, full stop, away from dollars into the new Chinese yuan CITS settlement system, which works without dollars at all. I mean, there are no dollars go through CIPS. So that is that. Now, the point is that there are huge numbers of dollars tied up in foreign exchange transactions. Because the way in which a foreign exchange transaction works, if, let us say, as a Brit, I want to buy yen, basically I sell sterling, buy dollars, I then sell dollars, buy yen. So the dollar is always in there in the middle. That is the way in which it works. It works on SWIFT and all the rest of it. The Bank for International Settlements did an estimate as to how much dollar credit was tied up in these swaps and foreign exchange processes and all the rest of it. And they reckoned it was around about $82 trillion. This is quite a substantial sum. On top of that, also, you have got the Eurobond market, which is offshore dollar bonds, which are not recorded in the US Treasury's Treasury International Capital Statistics, the TIC statistics. That's a further 13 trillion. So you're looking at a short 100, I think it's 98 trillion or something, which is not recorded by the US Treasury. Now, the US Treasury records there's a further 44 trillion of onshore dollars and underlying investments. And those underlying investments are bank deposits, US Treasury stock, corporate stock, agency stock, and then there's around about 22 trillion, I think it is, in equities, 23 trillion in equities. This is a very substantial exposure, which foreigners are now unwinding. Now, when President Trump started saying, I'm gonna go and invade Greenland, I mean, he was, I think, doing his part of the deal. You know, you make an outrageous statement and climb down from it. But the point is that all these shenanigans have encouraged foreign investors and powers not to invest further in US T-bonds. And not only that, but in some cases, such as Danish pension funds, they're actively selling their exposure. Now, so happens that the Danish pension funds don't really matter too much in the grand scheme of 38 trillion of debt. But you can see which way this is going. This means it's going to get a lot harder for Besant to fund the deficit, particularly when something like 10 trillion of debt has to be rolled over in 2026. So we're looking at a potential debt crisis for the US government here.
The global dollar system extends far beyond what official statistics reveal. Trillions of dollars circulate through foreign exchange swaps, offshore bond markets, and cross-border settlement structures. As trade increasingly bypasses dollar-based rails, this hidden dollar demand begins to unwind. At the same time, geopolitical uncertainty has reduced foreign appetite for U.S. debt. With large volumes of government bonds needing refinancing in coming years, funding costs are likely to rise. This creates pressure across asset markets, particularly equities, which are highly sensitive to interest rates.
So those are the two things which I think the Monroe Doctrine have really introduced, if you like, into the geopolitical mix. The first being that you can behave more independently of America if you're a foreign country outside the Americas, which means that you can align yourself with the Chinese who will invest in your economy. And not only that, but by upsetting outsiders, foreign entities generally, the people who have been buying US Treasury debt, they are likely to not be interested in buying any more debt, and indeed are probably net sellers in the next year or so. So that's the sort of, I think, the important change we have in the whole thing. And I can see that as people begin to think seriously about the future value of the US dollar, they will see commodity prices are really beginning to rise. I mean, it's extremely obvious in the case of industrial silver, also industrial platinum. While they're precious metals, we rarely regard them as monetary metals. And not only that, but if you look at copper, the price of copper has been rising as well. And to add to all that, recently we've begun to see the price of oil rising. I mean, WTI, I think, is up $62, $63 or something, having been as low as $55. What we are likely to see, and this comes from my analysis of commodity prices in gold, which should be stable over long periods of time. I mean, obviously some fluctuation, but they should be stable over long periods of time. Because of the consequences of fiat currency losing its purchasing power, these commodities basically are extremely underpriced. They have become underpriced because we look at them in dollars. We don't recognize that the purchasing power of the dollar is actually collapsing. So what this means is that in 2026, we are going to see massive inflation push from commodity prices for a start. And I'm sure there will be other manufacturing costs in there, which will, if you like, increase on the back of it. This is something which nobody really expects. And when you get higher inflation, which is really a loss of purchasing power of the fiat currency, then foreigners, and indeed domestic US institutions, are going to require compensation for the risk of investing in US treasuries. And that comes in the form of higher coupons. So you get higher coupons. What does that do to the stock market? It'll crash the stock market. I mean, this is actually a very, very serious development, I think. This sort of innocuous shift away from trying to control the world to the Monroe Doctrine. And I think what it does is it brings forward the end of the fiat dollar, really to starting this year. I think we are likely to see the loss of purchasing power of the fiat dollar really accelerating this year. And how long will the fiat dollar last? Well, I can only assume it will last into 2027. But I think the signs are it's not going to last much beyond that. So in terms of what this means for ordinary people, you've just got to get out of credit and get into real money, which is gold. So I think that's the bit about geopolitics. We could probably talk about silver now if
As currencies weaken, commodities begin to reprice, not because they are becoming scarce overnight, but because money is losing value. Industrial metals, energy, and precious metals are all reflecting this adjustment. When measured against gold, many commodities remain historically undervalued, suggesting further upside. Rising input costs feed into consumer prices, reinforcing inflationary pressure. Higher inflation demands higher yields, challenging both government finance and stock valuations. In such environments, history shows a clear pattern. Capital migrates away from credit and toward tangible monetary assets.